Okay, hello. So firstly, I'd just like to point out that in many regards, I'm just like most of you in the audience in that I'm responsible for managing, well, not just my family, but many families' portfolios and money through a fairly uncertain environment, complicated environment, and in some ways unique, in some ways same old sort of period of history. And so I say this because I don't really care if the price of gold goes up or down, right? Now, over the longer term, as you'll see, for a bunch of different reasons that many of you are aware of, we are quite constructive on what the price of gold and precious metals are likely to do for various reasons. There's also some scenarios that present some downside risk to precious metals and the price of gold even, and we're going to explore that a little bit later on. But like Kerry alluded to before, trying to anticipate the future is pretty hard. One of our biggest issues at the moment is this over-indebtedness problem, which everyone's aware of, and a lot of people have been trying to come to terms with that. When we come to terms, or try to come to terms with that, one of the most important aspects we are trying to wrestle with is when might the next debt default cycle meaningfully kick in throughout the broader world, both at a sovereign debt level, but also just in a private markets level, so non-sovereign debt. If we can get a bit of a loose sense for when, at least using history as a guide, to when the next debt default cycles, both in the non-sovereign and sovereign environments, are likely to occur, then at least we have a baseline of an expectation that we can perhaps test against. And then assess as new information comes to light as each year unfolds moving forward. And then we're better positioned then to be able to make decisions in our portfolios around how we balance different risks and all of this sort of thing. So I'm going to run through a few slides reasonably quickly. And the last half hour we've sort of set aside for questions and answers and exploring some of these topics a little deeper. I'm not completely sure which topics we'll end up exploring deeper. I'd like you guys to have a look through some of these slides as we go, write down questions, jot down some areas that you'd like me to expand upon or that we can maybe explore in the second half hour. There's about 20 or so slides we'll run through in the more formal presentation over the next 20 minutes or so. But I've actually got, in anticipation of some of the usual questions that have come up in the past, another 20 or so slides that we can run through expanding on some of the things that you see in this presentation. So, obviously this is all just general information. I have no idea about the future, but we're going to see if we can anticipate some broad probable scenarios. Anyway, so we're going to start off in the sovereign default cycle side of things. We've got some good data that goes back some 200 years or so that different academics have put together. It's fairly reliable. This is just quickly setting the scene with the amount of debt that we have in the world, which is ridiculous by a lot of levels. So when we start to think about sovereign risk, so sovereign as in government-issued debt and currency, a simple framework when it comes to how do we even start to think about risk of default when we're talking about sovereign nations that I find people find helpful. It's just a simple reality, responsibility, and room to move framework. This last point is actually quite important. Reality, obviously everyone knows, especially most governments in the world have promised way more than they can actually ever dream of fulfilling. And the US situation, for example, we've got unfunded liabilities. Actually, most countries around the world have unfunded liabilities till the cows come home. If they were measured according to generally accepted accounting principles, they'd be recognized as insolvent. And so the reality is pretty bad. Responsibility of stewardship in whatever country or situation. Obviously, we're talking about politicians, so that's laughable. Room to move is the most important one. The different levers and options we have to kick the can down the road or to play games to defer the bill coming due, right? And at a government level, they actually have quite a few levers depending on the country at play. Now, obviously, countries in Europe that are straitjacketed by the Eurozone sort of agreements and the currency and all of this sort of thing, they don't have a lot of room to move. So their reality is incredibly problematic. I mean, their politicians and their governmental structure is ridiculous. They have no room to move, and so they're already seeing the beginnings of a lot of, the sovereign default type initial stages and rumblings. We've actually been seeing that building over the last 10 years in different places around Europe, and they've had to create all sorts of distortions and contorted situations to try and wiggle away from the inevitable catching up with them. The USA, by contrast, as still the reserve currency of the world at the moment, has a lot of room to move. They're insolvent, and their political system is also ridiculous in terms of their stewardship, sort of character and responsibility and actions, or inaction. But they have a lot of room to move in kicking cans and playing games and shafting the bill onto other people or other parts of the world or other sectors of the economy. So they've got a lot more rope to be able to play games and delay or avoid the bill coming due. So when we look at the last 200 years, roughly, of sovereign defaults, so this is from a study a while back, 2015, I think it was published, but it shows they have a fairly broad definition of what default is for a sovereign entity or a sovereign nation. But loosely surveying about 125 different countries around the world throughout history, this is what it looks like. So from the 1800s right through to 2015, we can see this. When we see that, that's an increasing number of countries around the world in some form of sovereign default, And default can be everything from just frankly not paying debts or payments when due through to currency depreciation. There's quite a broad spectrum of definition. So obviously we're intrigued, especially given the overall indebted situation that we're in. When might this kick up again? Where are we heading out over the next 10, 20 years? Is there any way to gain some sort of credible or useful leading insight into these sovereign debt default cycles that are fairly recurrent throughout history? If we can get a sense for that, it has drastic implications for how we might position and manage and steward our portfolios over the next 10, 15 years. And so when I was thinking about this ridiculous objective of trying to figure out when the next default cycle might be, one of the things I've learned in markets is sometimes you don't necessarily have to have all the information on any given market. In fact, half the time it's impossible anyway. You'll never know all of the different myriad of factors and how to balance them, how to size them, how to integrate them all, and the net effects of everything washing into some market price, especially over the future. One of the things you can do is observe the participants, all right? So any given market will tend to have typical participant archetypes. You've got the speculative crowd, you've got some real money, longer term, sort of patient investor, value-focused crowd. You've got the career risk group. And so in a mining industry, for example, the boards of directors of mining companies are typically classically doing the wrong thing at the different points in the cycle. So when a commodity market tends to be peaking, that's when they're maxing out their CapEx expenditures. When commodities are washed out, that's when there's no CapEx ever, there's no funding for them, but they're sort of trapped by this weird incentive structure and a lot of career risk issues. It's the same in any given market, even in the banking industry and analysts. So there's these categories of participants we can look at that have different proximity to information, right? And we sort of understand how they behave relative to a typical cycle. And if they're closer to information that we don't have, we can watch how they're behaving and triangulate where we might be in a cycle. So, and we'll use that sort of a principle, or that sort of a concept a little later on when we're trying to get a sense for non-sovereign or private debt default cycles in history. So when we come back here, a sovereign default, or the preconditions to a government not being able to make good on its promises and leading to a default either through currency, letting the currency go, or just defaulting on its debt. The preconditions are usually pretty well observable by a large array of participants out in the globalized economy. And so typically those that are managing larger institutions around the world, or larger pools of capital that have more resource to throw at information and research, and they're just better connected and networked, will tend to get a sense ahead of time what's going on. And so as I was thinking about, well, how can we get leading insight on this? Also, when you spend too much time, like I do, looking at charts and through data and history, you tend to see things, you have this library of pictures in your head. And one of the pictures that I was reminded of when I saw this was that of basically the collateral value for gold. And what do I mean by that? When you get gold and you say take the ratio of gold to copper or gold to commodities in general, you're just that. It's a rough proxy of basically gold's collateral value or currency value, because we're stripping out, by dividing it by copper or dividing it by a broad array of commodities, we're stripping out the economic growth style underpinnings, or just the broader conditions that impact non-collateral type considerations. And so when I overlaid as much data as I could get going back about 100 years of the collateral value of gold, or the gold to commodities ratio, all of a sudden I started to see we've got a 10-year leading indicator on this sovereign default cycle, right? And it makes sense, because if you're managing large pools of money or whatever, and you're starting to see the preconditions 10 years, 5 years, 3 years in advance to, this government's ridiculous, or this king is insane, or there's no way we're going to be able to deliver on all of these promises, et cetera, what are you going to do? You're going to, at the margin, start to be buying more gold within your broader or precious metals, to kind of hedge that predictable currency devaluation or write-off or default type environment. So we'll swap across. So here, I only have data going back to 1910, and to get a gold versus broad commodities index, I kind of had to substitute oil at the back end here just to extend the data look back. But it's staggering. And this is all pushed forward in time, 10 years, by the way, just to show the leading relationship. So these are the global default cycles, the number of countries in some form of sovereign default. And this is the collateral value of gold. And it's the same picture, only we have a 10-year leading indicator. This suggests that around 2022, 24, roughly, is probably when we're going to see peak pain or peak conditions of sovereign default around the world. Now, we're already seeing it build, right? And even over the last 10 years, we've been starting to see more and more instances of different nations around the world. It always starts with the weakest out at the periphery, and it slowly cascades in towards the bigger, more core countries in the world when we get these sovereign default cycles. So probably one of the last countries or regions to actually really get caught up in this possible default cycle to come will be the USA, because they do have more room to move, and ultimately they've got the deepest capital markets, the reserve currency issuer, et cetera, et cetera, et cetera. They'll be towards the end of the line to get hurt. because they have more room to move in these sorts of environments, to shaft the bill onto other people and to play games to delay the inevitable. So this gives us a bit of a baseline sense for a bit of an expectation moving forward. Now, like I say, trying to predict the future is ridiculous, and this is a bit of a, ridiculous exercise in its own right, but at least it gives us a reasonable sense for what might happen and the timing of that. And so as conditions unfold and we get more information and data, we can better assess whether we're on track to this sort of a thesis or whether something is materially changed to cause us to actually deviate from this progression. So, when it comes to non-sovereign or private sort of, non-government debt cycles, at least in the more recent, 30 years, the present regime, what happens in the US pretty much leads or mirrors at least the broader global credit cycle, more or less, or credit conditions, debt conditions. And so when I was thinking about how do I just quickly survey just a bit of a sense for that global non-sovereign credit cycle, this is one way to just triangulate it, and this more or less covers, or these different metrics more or less covers a bit of a sense for what's going on in the broader global credit conditions, capital market conditions around the world. So we combine US corporate credit spreads. It's on a log scale, that's why it's a bit funny to what you're probably used to. US lending officer survey, so this is the ease or the tightness of their willingness and the terms they attach to loans and lending. And then not the S&P 500, but the S&P 100, just because I had more history on the implied volatility. So volatility is like, one way of looking at implied volatility in any given market is like the price of liquidity, right? So symptomatically, and this more or less overlays with most of the meaningful ebbs and flows of global credit cycles in the world and credit conditions. So what we're trying to do is get a bit of a leading sense for these conditions, these sorts of cycles, just like we did the sovereign cycle. Now, typically in history, you'll get the because the government has the ability to tax and pass law and send soldiers or people, armed men and women to your door to enforce their will, the private sector obviously tends to go belly up first before the public sector goes belly up. And so, loosely speaking, we would expect a non-sovereign debt default cycle to slightly precede a sovereign debt default cycle, more or less. And because what ends up happening, actually, just like we saw in the 2008 sort of period, the private issues become public issues. The only problem is this time the public sector has less capacity to bail out the private sector when issues ensue. So how might we actually gain leading insight as to this global credit conditions, or and whenever we see these sorts of spreads going up, increased volatilities, tightening loan condition, that's symptomatic of default style environments where bankruptcies will be rising, unemployment's rising, debt obligations, increasing percentage of them are in default and non-serviceability. And when all of these lines sort of fall, that means credit conditions are easing, defaults are falling off, et cetera, et cetera. Now, actual formal defaults sort of lag a little bit, some of these metrics, but it roughly is coincident with what we're looking at, and it's emblematic of what happens around the world because the US is so embedded at the core of global liquidity and credit conditions and capital market conditions. So the first point before we go into the next slide, which starts to illustrate one way of gaining leading insight into this global non-sovereign debt default cycle, is you may or may not know that the US Federal Reserve hardly creates any money, right? Most of the liquidity or money creation that occurs in the economy and in the world happens outside the Federal Reserve, as you would probably know. And a lot of that money and even US dollars that are created happen outside of even the USA itself, beyond the ability of the US government to regulate through its different mechanisms. Now, it has many different, that broader globalized banking system goes by many different names. Some call it the shadow banking system. It's more formally known as the Eurodollar banking system. Eurodollar as in international dollars that are created, or dollars and liquidity and credit and all of this sort of stuff that are created apart from the USA. And the quantities of dollars that are created in that broader system at different points in time can dwarf what is created within the US. And so the money creation or the effective purchasing power creation of US dollars extends well beyond the borders of the US. And this Eurodollar banking system is kind of staggering in scope and staggering in vulnerability too in some ways. So obviously this might be touching in areas we may explore later in question and answer time, but I'm going to kind of keep moving because when we look into that Eurodollar banking system, so all the major financial and banking institutions around the world, the people that are at the very core of making the executive decisions around managing risk of their balance sheets and their activities, essentially are at the core of a little bit of a self-fulfilling dynamic. Because if they as a group collectively start to be more confident and expand and be more willing to take risk and to make loans and to create money and liquidity and all of this sort of stuff, then surprise, surprise, conditions get easier. Money is more abundant, it's all of this sort of thing. Vice versa, if they are starting to get concerned about whatever it is and collectively they start tightening up the reins of risk in how they manage their balance sheets, their exposures, all of this sort of stuff, then that has knock-on effects which in times to come, in years to come, actually tighten the broader global environment. Liquidity starts to deteriorate and even contract. That credit cycle kicks into reverse. And so whatever that, so you know how we were talking about earlier on, sometimes we don't have that close proximity to information, but we can observe the behaviors of those that do have a closer proximity to information. And so when we're talking about these sort of more patient sort of balance sheet managers or just embedded in that broader global banking system, when they start to get more risk averse and tighten up their propensity to assume risk, then that has knock-on effects which tightens the global environment and establishes the preconditions to bad things happening out in the capital markets in the broader world. So, bit of a long story, but one of the ways we've been able to identify through different money flows and things in the Eurodollar markets how these guys are managing their balance sheets. And surprise, surprise, it gives us a 3-year leading sense for these global credit condition cycles. What does it look like? This. It's a bit of a busy chart. This is the same chart as before, but I've overlaid this blue line. And you'll notice, and so what happened, and this is pushed forward in advance, about 3 years. What happens is up here, when the blue line's up here, that basically means that global banking system and a lot of the participants in it are starting to become incredibly risk averse. They're tightening up their risk profiles, their exposures. They're starting to batten down the hatches, so to speak. And when they do that, that sets into motion a domino chain of consequences which 3 years later lead to a very tight liquidity and credit environment globally, which means it's a high probability environment of defaults, bad surprises, bad things happening, generally speaking, around the world. Now, as you see, when these guys get aggressively defensive, these are the sorts of bad things that have happened. So that it tends to track 3 years in advance these broader, private capital market and credit condition cycles. But when they really get aggressively defensive, as opposed to very confident, and the flip side, bad things tend to happen. So we have all the major global issues that have occurred over the last several years, and so we're back at these conditions now. In fact, this chart was, I put this together in the middle of 2017. I didn't realize it at the time, but this was about to go to all new highs. So they hadn't actually finished their defensive sort of operations. And so back in 2017, I just speculated as to, well, what might happen this time? Because every other time this happened, 3 years later, we had all these bad things happen. So this time, there's lots of candidates, depending on what region of the world or where you're at, is for negative surprises. So this is the updated chart to the present. So obviously, volatility, price of liquidity, the shift in lending conditions, even the jump in credit spreads are all kind of more or less happening according, like right on time, according to this loose theory, for whatever it's worth. But we do have this massive peak culminating around 2021. So like I say, this is a ridiculous exercise trying to predict the future, but at least we've got some common sense foundation, sort of, as to when things might happen. So this implies a private debt default cycle in the world, possibly crescendoing around 2021. Okay? And so at that particular time, now we can still sort of, there's a lot of different paths to get to that point between now and then. So we might even, have more eased or relaxed conditions globally, for the next 12 months and still continue to transition beneath the surface into this incredibly tight and potentially problematic environment, a couple of years from now. Or we might go there in a straight line from here, I got no idea. But at least we have another baseline methodology to have a sense for, well, when might problems happen? Now, if these private and sovereign debt default cycles don't happen, fantastic. All the other things in our portfolio are going to make money. If they do happen, then at least we've got an eye to potentialities, at least using history as a guide, and we can adapt as and when is necessary. So, back to that original question, when is the next global debt default cycle likely to be due? For whatever it's worth, my best guess is probably around that for the sovereign default, and the private debt default cycle in the world probably around that date, 2021. So this is just one way of having a guess at what might be possible. Obviously, like I say here, we hold these views pretty loosely, but at least we have a baseline thesis to just compare the unfolding of events against. Now, just a few basic points before we move on. They're not really basic, but there's a scenario that is a little bit more negative for the price of gold, just in the shorter to medium term. It's a possibility, it's not a certainty. Over the longer term, it seems to be pretty bullish overall for a lot of reasons which I think you would all be familiar with. Now, the key point I want to make here is that sovereign default cycles, when governments renege on their promises, that tends to have an inflationary context to it. And their currencies pretty much get destroyed or disappear. When the private sector or the non-government sector go through a default cycle, that tends to be deflationary in nature. Dollars or whatever the currency is becomes more scarce, trust disappears, liquidity, credit, productive activity even, it all just sort of shrinks and everyone goes into more of a hoarding and hiding mode. People become trapped, that's where you get panics, they want to get out, they can't get the pain, etc., etc. And so that tends to be, that scramble for dollars or currency and whatever the regime is, contraction of liquidity tends to be incredibly deflationary. And where in an inflationary sense, if you have more dollars or more currency chasing the same amount of gold, the price of gold will go up, but the reverse can also be true, where you can actually temporarily have a harder currency than gold. And it can be a harder currency than gold if that supply or that quantity of currency is contracting, at least temporarily, at a faster rate, or a negative rate against the same amount of gold, so the price actually goes down. This is loosely the main risk that I want to assess in our gold holdings or our precious metals part of our portfolio over the next, say, 4 or 5 years. It's easy to see the upside potential in precious metals. I just need to be a little bit mindful of drawdown risks along the way to getting to whatever those upside potentials are in our precious metals holdings. And so just so you know, in our portfolios, because of our specific mandates of capital preservation and things, we actually hold anywhere between, depending on conditions, anywhere between, say, 5 to even 30-ish% in precious metals. Okay, so we're probably a little on the more extreme side when it comes to our embracing of precious metals in investment portfolios. So when it comes to so this is probably the key possible risk that I just need to be able to assess over the next 5 years. I'm a little bit worried that if this banking system globally, because there's so many unsustainable dynamics and there's balance sheet capacity issues, a lot of that gets a little bit more complicated. I'm just a little bit worried about the potential for liquidity issues or deflationary shocks prior to any, especially US government type reaction. So central banks are notoriously reactionary. They don't really have a clue what's going on. Just like, I was going to say just like us, but so central banks don't actually know what money is, right? And I don't just mean that in the sense of they don't know what money is because they don't really appreciate the benefits of, say, precious metals. I mean they actually don't know how many, like the Federal Reserve, we've got 2,000-something PhD economists on staff, but they've given up trying to estimate the total effective liquidity or dollars in the broader system. It's hard to define. Purchasing power in the form of dollars and liquidity can pretty much be created out of nothing in the different system, and also it can be transferred. You get a preference shift in the broader environment, and all of a sudden they can have a wave of liquidity come into the US that doubles their money supply. Bit of an extreme way of putting it, but it's so nebulous now because there's so much, even securities, the whole shadow banking system has come about because they needed to make securities like cash, and so a lot of securities markets, so for example, the US Treasury system, the US Treasury bonds are owned by 2 or 3 parties who think they have an ownership claim over that underlying Treasury security, right? And the shadow banking system has sort of arose to be able to turn securities or exchange-traded securities effectively into money or money-like instruments that can back credit and all sorts of liquidity creation and all sorts of things. So back a few decades ago, the central bank, particularly the Federal Reserve, realized we don't actually know what money is, so we're just going to focus on interest rate targeting and we'll pretend we know what's going on. But at the end of the day, all they do is react. So if we have a crisis or some issue come unstuck in the banking system, they will take a while for them to react. At first, they won't act in a very big way relative to the potential issues that could be unfolding in this broader global banking system. Eventually, they will overreact and then turn a banking system problem probably into a currency problem. And so any initial shocks in that broader global banking system probably will be deflationary and see a liquidity contraction. That translates more or less into a real yield spike, which is not really ideal for the price of gold. Probably just going to be transitory though, so that's potentially some fantastic buying opportunities if this were to happen. Now, like I say, the long term, it's kind of easy to see the tailwinds to the price of gold and the precious metals story, et cetera, et cetera. But as a portfolio manager, I just need to be aware of, well, what are the scenarios around drawdown risk in my precious metals holdings, and how's that going to balance with the other things I have in my portfolio. The real elephant in the room is also this over-the-counter derivatives problem around the world. So derivatives are just pure bets. It's like going down to the TAB, placing a bet on a horse race. It's pretty much all that's going on in this over-the-counter derivatives world. Problem is, it's one of the last remaining ways for the major banks to still make relatively easy money. And of course, they don't have to foot the bill if all of this goes wrong. The public sector will, because of the moral hazard that we've all created in governments bailing out the banks and not really holding any of the executives to account, et cetera, et cetera. And also this situation now, this over-the-counter derivative world is so big that there's no, like they've effectively held every government around the world and policymaker hostage. Anyway, so derivatives fund nothing. They serve to shift exposure from one party to another and work through margins or collateral. Yet they carry all the bankruptcy characteristics of debt for out-of-the-money party. A sudden move in volatility or unexpected change in market prices or conditions or a lack of liquidity can shift the gross, so the margin that they need to post incredibly quickly and their netting and the profitability of their positions. So this is kind of a curveball out there risk that really kind of makes me pay attention to just that drawdown, possible drawdown scenario that I might need to have to, navigate through or actually buy into if it were to happen, add to my precious metals exposure. Because this can really turn a deflationary shock into one heck of a deflationary shock. And so then that would knock the stuffing out of the price of gold temporarily. So like I say, buying opportunity. Anyway, so this is what the giant pile of derivatives looks like out there. So by the way, this is estimates of total world debt. These are US dollars, trillion US dollars, right? This down here, this little orange line is what total global world GDP is. These are total central bank and commercial bank assets so the banking system assets in the light blue line, including central banks of most of the major countries and regions that kind of matter in the world. Global debt is here, notional derivative value is up here. Of course, all of these derivative values are more or less netted, and in 99% of the time, that means that this pile of derivatives doesn't really matter too much, because where there's a winner, there's a loser. The issue is in unstable or adverse conditions, that netting comes unstuck. If someone can't pay, especially because this is an interconnected, globally interconnected world, and we're going through conditions that are not cooperative globally, but competitive globally. So those interrelationships are pulling apart. So how are we going to enforce a derivatives contract or some other contract with some party in some other country in some other jurisdiction under stress and instability environments? So this is an amplifier to any deflationary shock risk in that broader global system if we were to get a private debt default cycle anytime in the next 5 years, which hopefully we don't. Anyway, how do we think about a portfolio solution to this? And I'll try and fly through this in the next 2 minutes and then we'll get into questions. So the essential concept that everyone underappreciates is in the natural world, in the natural sciences, natural ecologies and natural systems, there tends to be two characteristics that really matter when it comes to survivability and the prosperity of that system, and the ability to withstand adverse or unpredictable change. And that's obviously resiliency characteristics and efficiency characteristics. Now, when you think the typical business owner is all about profit, how can we streamline everything to make everything more efficient, but in their pursuit of efficiency, they become very inflexible. Whereas resiliency is more like a diversification concept, multiple streams of revenue, multiple capabilities, the ability to adapt to unexpected adverse change. The key lesson in natural systems is that the actual ratio of resiliency characteristics to efficiency characteristics is 2/3 resiliency, 1/3 efficiency. Now you think of our portfolios and or at least the conventional way of constructing portfolios, they're literally designed to be efficient relative to the last 50 years of financial market experience. And I'd suggest to you that the next 25 years of capital market conditions are not going to be like the last 50 years. The last 50 years, we saw the build-up of this credit cycle, so we had tailwinds and a cooperative world. The next 25 years, we're dealing with the consequences of that over-indebtedness, and we're having a competitive, fracturing world. Very different environment. So what we need to consider, both in our personal lives, our businesses, and our portfolios especially, is resiliency characteristics. Can we adapt to unforeseen change or even profit from them? If we have purchasing power or liquidity or money when everyone else doesn't, we're basically king of the hill. We can go and buy assets for cents on the dollar, et cetera, et cetera. So we want to be in a more resilient footing so we can take advantage of any issues, shocks, crises, whatever, or unexpected adverse change if and when it happens over the next 25 years. So every single asset class or currency even maps to growth, inflation, and capital flows. So some combination of that will favor a certain asset class. And so if you want to start thinking about resiliency, well, start thinking about these basic building blocks of diversification. Now, obviously, I put this quality concept, that's a pretty loose term, but really what you're looking at is the last in line to be hurt, right? If we were to go into sovereign default conditions or adverse environments, which nation or which nation's bonds are going to be more towards the end of the line to be hurt? And so it's a relative game. Anyway, by starting with these basic building blocks in a portfolio, that gives us resiliency, because any unexpected change, either positive or negative, some of these things will go up, some of these things will go down, but overall we'll more or less retain our purchasing power. Does this work in reality? Well, yes. There's a guy called Harry Brown, calls it a permanent portfolio, just simply 25% to cash, equities, bonds, and precious metals. It's more or less held its purchasing power through all sorts of environments over the last 100 years in different currencies. One way of doing it. The problem with that is you don't really get much of a return. You more or less just maintain your purchasing power, but at least you're resilient, perhaps too resilient and not efficient enough. The way we run money is basically to take these sorts of principles and all the stuff we've been talking about and create a portfolio that is a mix of assets, but we've found, at least for the last 6 years, we've been able to more or less keep up with the share market's total return, but with 50 to 70% less risk, depending how you measure risk. So less volatility, no correlation to anything, because we're building on those building blocks I talked about before. No derivatives, no leverage, keep it all simple, but it works. And by being a little bit more proactive on different things, we can still generate respectable returns, even though our focus is capital preservation and being conservative. So these are some of the metrics. So drawdown, for example, these are our portfolios. So our main one, similar return to the share market, but since inception 6 years ago, the share market's fallen by almost 17%. Our biggest fall is like 5%. And volatility, much lower. Zero beta, basically, to anything that moves, etc. So wrapping it up and going back to gold, obviously these are the target dates. We hold these forward-looking views pretty loosely because who knows what will happen, but at least we have a scenario to benchmark against. When it comes to gold, it's probably not what you want to say at a gold conference, but at least over the next 5 years, because of these banking system liquidity issues, deflationary shock risk issues, I'm not saying it's going to happen, but the upside of gold is pretty clear, it's pretty obvious. Everyone here knows the long-term benefits of precious metals and its return potential. However, as a portfolio manager, managing my family's money and others, I need to be at least mindful of what risks are out there that could see the precious metals holdings I have decline, or at least temporarily, and present buying opportunities for me. And this is loosely the way I think about it, for better or worse. And so I'll wrap up with this. Obviously, everything we just discussed is just all hypothetical and general information, just trying to bring out some principles and perspectives. And we'll open up the floor to questions. I've spoken too long, but we'll still have 10 to 15 minutes of questions if anyone has any.
Ladies and gentlemen, please thank Daniel Want, and we're now going to... Thanks, man. I said to you right at the start, this is going to be an interactive, and I don't want everybody to sit there going, it's going to take a while to take this in. I've got a couple of microphones around the floor. I'm going to take one on this side, so if I can get a microphone, gentleman with his hand up here, and then Mike will take you.
Hi, Daniel. The Federal Reserve explained it would inject $60 billion a month. They're at pains to tell the media they don't want everyone calling this QE. And so if it's not supposed to be stimulative, and we're all in benign times, when we really hit the fan, how much are they going to need to pump in every month?
A lot. So when it really hits the fan, like when we go back to this chart. Now the world, for better or worse, at the moment revolves around US dollars, right? There's not a lot of other things that matter from a liquidity and funding and capital market perspective. So we're talking in less than 100 billion or whatever at the moment of repo activity as the latest development daily that they have to keep rolling over. So this is the debt level of the world. Now, not all of that is obviously in US dollars, but at the end of the day, the only thing that's really going to matter in a private debt default and a sovereign debt default environment is US dollars and then eventually gold. But that initial doorway will be a scramble for US dollars. And so we're talking about potentially a whole, especially if this derivatives thing creates an amplifying effect on any negative crisis or shock or issue over the next 5-ish years. That's a bigger hole than the Fed will initially be able to fill, right? Even if we get a deflationary shock, some sort of a negative banking system issue in the world that cascades a little bit, even like a 2008 style thing, if it were like that, I got no idea, then you're talking about probably a dynamic liquidity contraction, a US dollar system liquidity contraction, which is broadly globally defined. That's a contraction measured in trillions, probably tens of trillions easily. And there's an outlier risk with this derivative thing that tens of trillions turned into, lots of tens of trillions. So the Fed is reactionary. I can guarantee it. They'll be like, whoa, what's happening? They'll act, but in a manner that is insufficient for the magnitude of the hole that's opened up in that broader system, right? Eventually, they'll go, wow, this is bad, or this is not working, let's do more of it. And they'd have to multiples of the size of their balance sheet eventually to plug that gap. And then eventually they'll overreact, right? And this will be all the justification for like MMT or who knows what sort of fiscal interaction as well, where the Fed basically are given license to just expand their balance sheet ad infinitum. The biggest issue as well, semi-related to this, there's a big difference between US dollar liquidity that's created from non-central bank sources versus US liquidity that's created from the Federal Reserve. The Federal Reserve created dollars indirectly as an act of, coercion, basically. they can force and decree the creation of liquidity, whereas the liquidity that it comes into being outside of the Federal Reserve, at least it's transacted and created by willing parties. Now, there's moral hazard issues, but the source of dollar creation is incredibly important. And generally speaking, if dollars are being created by central banks as opposed to the broader non-central bank system, they're a lot worse than that broader system, generally speaking. But that's another can of worms that I probably shouldn't have opened. Another.
Right, gentleman right down the back.
Yeah. So, Mike Harrowell from Red 5. I've just finished about 2 weeks of marketing in the US, and the feedback from a lot of the investors there was that the trade discussion between the US and China is not a Trump tweet. It's actually deeply embedded policy inside the US with the objective of slowing down China's growth on a very long-term basis. And it's a policy that'll last no matter who is president and no matter who tweets what. I guess, first of all, asking, would you confirm that? And the second thing is, if their objective is to engineer lower Chinese growth, by implication that means lower world growth. And so how does that play into the scenarios you're outlining?
Okay, possible. What I would suggest, however, at least what I've learned in studying history and then markets and then operating in markets, if you get the underlying conditions roughly right as to what is really going on at an underlying deeper core system level, surprises tend to happen in the direction of those underlying conditions, right? Events tend to just be symptomatic expressions of those underlying core conditions. So for example, like with the trade disputes and all of this sort of stuff, you know, the world economy, the world banking system, the world like the whole world regime of the last 30 years more or less came to a bit of a screeching halt around 2007, 2008. And all of these over-indebted issues, unsustainable imbalances, especially balance of payment issues over, you know, across different nations and relationships, all of these sorts of things, these core issues, started to become revealed for what they were, which is unsustainable and potentially, as time unfolds, unmanageable, right? And so everyone collectively started looking at each other around the world, going, who's going to be left with the bill? I don't want to be left with the bill. This is not going to end well. Can I, you know? And so instead of having that coming together of the world that we've had in trade, in regulation, in banking, in everything for the last 30, 50 years, it's starting to fracture. Right? And we're also, because of the policy responses of a lot of, you know, that are beneficial for financial markets as opposed to the real economy in propping up all of this crazy imbalances and unsustainable dynamics, that's created a lot of these inequality issues and basically the populism that's rising and all of this sort of stuff. And so Donald Trump, China, that's a symptomatic expression of this underlying core dynamic that is rolling on beneath the surface. All of these things are just a symptomology of those core issues. And so if we can get those core issues roughly right, then surprises and events tend to happen in the direction of that, or those underlying trends. And so back to your question a little bit, I see a lot of that as just, okay, that it's just all symptomatic of these underlying things of a world trying to deal with these unsustainabilities and tearing itself apart. And so rationalizations or agendas tend to just fit those underlying dynamics that they're having to wrestle with. So I'm not sure at a surface level what the reality is there, but I know it's just classic symptoms of what we've been tracking and documenting since 2006 of a world unfolding.
Take the gentleman, I think, yep, question just here. Thanks, Candice. And then we'll go there.
If I understood you correctly, you mentioned that US dollar is still predominant in world economy. And my question is, how is this dominance being balanced or challenged by the BRIC Brazil, India, Russia, and China bloc?
Yeah, I mean, clearly we're the beginning of the end of the US dollar reserve currency sort of regime in history, but that end chapter, it can go on for a long time. The BRIC, the Brazil, Russia, India, China, machinations towards challenging US dollar, like that's a natural response, especially now the US has weaponized increasingly its financial system and the US dollar, et cetera, et cetera. Of course they want to get away from it, but at the end of the day, when you line up 10 random investors or people or families around the world and go, what are you going to trust the most, at least temporarily as a store of wealth? You know, is it going to be a Chinese renminbi or some currency like the ruble, or is it going to be the US dollar and like precious metals or something? I'd suggest to you that still, even with all the problems of the US is a total basket case, and when you analyze the US, especially through a currency lens, you're like, this is crazy. And then you go and analyze the rest of the world, and then you're like, let's have a look back at the US. It's crazy, but you know, compared to all of this, at least here we have the inertia of a legal system that is still intact, roughly. They're white-anting it, but at least it's still intact. So a contract still more or less means, a contract means more in the US than it does in China, than it does in Russia, than it does in Brazil, right? And any currency is basically a product of its productive population and output in combination with the integrity of its currencies and a legal system that still, the integrity of its contracts and a legal system that still more or less values and protects life. And so I don't see the US dollar really being challenged by the BRIC currencies, maybe at the margin, but in substance, you line up 10 people who are reasonably informed about the world, they're still going to run to the US dollar and precious metals before that, and they're just, the BRIC currencies are not really going to be much of a thought, because contracts still matter, sort of. You know, there might be a period of time in the future where contracts don't matter that much in the US, but for now they still do, same as here in Australia.
Right, and we've got a couple more. We've got one just here.
Thank you very much for that. One thing you haven't mentioned, and I know it's 2 orders of magnitude smaller than those markets at present, but I'm wondering, under the sort of banking system crisis and default scenario you've painted, what's the impact of those things on Bitcoin and other cryptocurrency movements, and do they play a part in this?
So if you were creating disaster insurance, obviously you're going to have some gold held somewhere in a jurisdictionally diversified manner. Just for the hell of it, you probably have a little bit of cryptocurrency just in case that actually ends up working. The issue is
You can't say that. We're talking all about digital tomorrow, Daniel.
look, it probably will work.
That's called hedging.
Okay, so by fiat, by decree, the government in most places that any of us would want to live, by decree, can make our life hell. They can take our stuff, throw us in jail even, all the rest of it. So decree has value, has weight, has consequence. And so if they wake up one day and they feel their agenda threatened by cryptocurrency, even gold holdings or whatever, our access to gold in a vault is still predicated on a contract having integrity. And if that contract doesn't have integrity because the laws of the land have gone, oh no, we're going to change that, there's vulnerability there, there's risk. It doesn't mean it's going to happen, but cryptocurrency is still subordinate to, like, while ever fiat, by decree, by law, while it has consequence, it's still subordinate to that. And so if the governments are getting threatened in whatever way, shape or form by a cryptocurrency concept that they don't author themselves, by decree, they're going to make our life hell trying to own that stuff. Don't know. So, probably other people smarter than me that can answer that better.
We've got a ton of questions coming out here. We'll take one here. I've probably got time for just about 2 or 3. Yep.
A little bit similar question to the previous one, but does gold play a part, do you think, in a currency reset? Will a currency reset occur, and will it happen before the shit hits the fan?
That was a technical term.
Yeah. We're in Australia, that's how we work.
That's how we roll.
That's right. So there's no way government will preemptively or proactively address any of these issues. They will react to them once they blow up in their face, basically. Then they will come in, look like heroes, or try to present themselves as heroes to fix the problem that has just blown up, that they actually authored anyway. But that's another story. And so proactively, no, they won't affect a reset, or I doubt it. I can't, and probably history is not a, they need to be in a world of pain or some form of crisis for them to finally react. And then their initial reaction probably won't be enough, and then they'll overreact, and then we'll have other issues to deal with. If you're asking, are we going to go back to a gold standard, which may be a part of that question, I doubt it, but who knows? I'd be a little bit surprised if that happened. But we can all back ourselves with a gold standard separately, privately. We're just going to be a bit careful in how we do it, especially if the laws of the lands change. Anyway.
Gentleman just here.
Hi, just a quick one on that same theme, and just referring to what they were talking about with BRICS. What about IMF's play with SDRs, going to that as a reserve?
Yeah, it's possible. The hard thing, I guess, is that they don't create a straitjacket, because there's lots of moving parts that they're trying to peg together in that concept. And realistically, are they going to be able to build mechanisms in there for flexibility and all the rest of it? I doubt it. I don't know. It probably will be a solution. I doubt it will be a fantastic solution. Not sure, sorry.
Do we have just a question right here? Just wait for the mic. Just coming. I'm going to take this one, gentleman back there, and one here, and then we're done. Sorry, we're going to keep going. Yep.
I'll be showing my ignorance here, but the banks, the Australian banks, they have these swaps, credit swaps, and they were sort of, a few years ago, that's 40 billion, one of them. And I thought, what does that mean? And what is the risk involved in those swaps? I haven't been able to get an answer from various people.
It depends who you ask. The official response is like, oh, that's all fine. It all nets out. It's just a risk management, whatever. Look, at the end of the day, the 40 billion of swaps, meaning in anything is defined by context, right? You change the context to something, you change the meaning, right? And so we need to inquire as to what is the context in which those swaps are operating. In normal conditions, 99% of the time, they're probably fine. In sub 1% of conditions in a crazy default cycle that gets out of hand, then yeah, that could be an issue. That could be part of that amplifying effect. And so, who knows? But see, this is a problem with the over-the-counter derivative world, is they've gotten really creative and really aggressive, and they've synthetically recreated all sorts of different things that appear off balance sheet. Funding type exposures, and so it's a very opaque world. I don't think anyone, like even these estimates of the notional value of derivatives, now that's BIS, Bank of International Settlements data. I've seen credible estimates that, are up to double that, and like no one really knows because all of over-counter derivative or a swap is just a contract, like a Word document that's copied and pasted, and they sign it. It's just a betting wager. And in fact, a lot of this system came up, especially in this run-up in 98 to 2008, that actually occurred when they repealed bucket shop laws in the US, right? Anyway, probably too big a topic for 1 minute remaining, but sorry.
Yeah, we got 1 minute. I'm going to take this very last question. I'm sorry. I know there's lots more, but we'll just take this last one. Got 1 minute.
Earlier this year, the Basel III banking regulations reinstated gold as a tier 1 asset for about the first time in 40 years. Would you like to make a comment?
Probably a step in the right direction. The thing with banks, and especially, you know, the capital, like the risk with banks is not in the bank, it's in the interrelationships the bank has in the context. The context, again, defines most things. And so it's those interrelationships the banks have with everyone else in that broader system is where risk lies in a bank. So if you analyze a bank, especially through like capital adequacy, et cetera, you're pretty much wasting your time. You need to take a systems approach to how does that bank interrelate with everything else, and take a systems view of trying to assess vulnerable areas or conditions or inflexibilities. Because that's what actually matters when assessing bank risk.